Okay. Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week again with the S&P 500, the NASDAQ 100 continuing to print new all-time highs after what has been a relatively strong week of both economic data and earnings reports. We have the VIX below 17%, suggesting that markets have very little concern around the tariff deadline of August 1st, despite the fact that, there seems to be some tensions with the EU and whether or not we can get a trade deal done before that date. It seems like the market has kind of taken a lot of the news from last week as a relatively positive outcome, with the roughly 10 to 15% tariff rate that's going to go out to roughly 150 countries on August 1st. That is viewed as a more subtle version of what some people were concerned about with regards to, tariffs for the rest of the world. We had a bit of a spat last week with regards to whether or not the Trump administration was going to have an independent Fed. It seems like that has been largely resolved, and the market has taken that as a positive. And just overall economic numbers last week came in stronger than expected. Specifically, retail sales came out much stronger than expected. And it aligned with the information that came out of some of the early earnings reports. You had both Delta, JP Morgan, some of the major banks that really spoke to the fact that they believe that the second half of 2025 looks a lot more optimistic and clear with regards to consumer spending. The retail sales number came out higher than expected, kind of confirming those views. And I think that's really what's driven the markets higher here over the last couple of weeks, despite what has been already an over 30% rally from the April lows, one of the strongest, fastest moves we've seen in history of the S&P 500 that has largely gone unchecked. We haven't really seen any pullbacks, any consolidation. The markets just continue to move higher here. And the only thing that really, is kind of flying in the face of all of this is really where bond yields remain. You have the 10-year yield that currently still remains fairly elevated, even though it's come down a little bit here on Friday and today. We've pulled back from that 4.5% level on the 10-year back down to 4.3%. You have the 30-year that was above 5%. That's now below 5% at 4.94%. But largely, interest rates still remain fairly elevated here at the moment. And that's probably the biggest concern that I still have with regards to the overall market. But, from an economic perspective, from an earnings perspective, things have certainly shifted a little bit here, with regards to expectations, with the exception, again, like I said, of interest rates, which at the moment, is now, it has a 41% chance that even in September, the Fed leaves interest rates where they are. The stronger the economy is with higher inflation, the more likely we're going to see the Fed potentially continue to hold interest rates where they are right now rather than cut. So those are some of the things that I'm looking at from a macro perspective. This week, we have quite a few things to look at from an ideas perspective. So I'll kind of highlight a few that I think are worth paying attention to here right now. And the first one I want to point out, which is a new one here for the week, is Pinterest. Pinterest recently, as you can see, the stocks have been really trading sideways here for the better part of a year now. With kind of an earnings announcement earlier this year that kind of broke out here, but it ended up trading all the way down to below 25. The stock has really recovered a little bit, and you can sort of think of this as a bit of a inverted head and shoulders, which would target this level here to the upside. We are pretty close to that level here, but overall, you've got this breakout here recently above this $35 level. You broke out, consolidated after breaking out, retested 35, and now we're breaking out here again. So Pinterest trades at 21 times forward earnings, which is basically in line with the industry, but EPS and revenue growth is expected to outpace the industry by a pretty hefty amount. 23% EPS growth, 14% revenue growth. That's quite a bit higher from the industry average. And net margins, this is the one thing that net margins right now look quite strong here, but that is because some tax credits. So we'll see over the next couple of quarters where Pinterest comes in with regards to profitability, because right now it looks artificially inflated because of some tax credits it got a couple of quarters ago. We'll see kind of how the net margins look over the next couple of quarters to kind of give us a better view of how profitable Pinterest will be in the future. Now, historically, Pinterest is a company that largely has broken even and hasn't really turned much of a profit in the last few years. But as they focus on profitability, that's really where the valuation could potentially see some higher multiples if they focus or if they're able to show their ability to turn a profit. The next one I want to take a look at here is XYZ Block. This is one that we spoke about here last week. Block has had a really nice breakout here recently in the last couple of days. We've spoken about this stock, as it kind of broke out here above the $63, $64 level here, broke out, came back to retest this level of support, traded up to 70, pulled back again, and the stock has really taken off here right now. Our upside target here is around 82 and filling that gap. So we're very close to filling that gap here right now. If we can fill that gap and break out higher, then we're really looking at closer to around $100 to our upside target here for Block. And it still trades at a very low valuation. It's trading at only 16 times forward earnings, where the industry is around 26 times forward earnings. So still a very heavy discount to the industry, even though it's expected to grow significantly faster, both on top and bottom line. It's more profitable than the industry by a pretty significant margin. So for all of those reasons, I believe Block is significantly undervalued and has some substantial upside opportunities here. And this kind of bottoming formation that it completed and now it's breaking out here is really kind of a great time, in my opinion, to start adding stocks like this to your portfolio. Another one that we looked at here for the last few weeks here is Norfolk Southern. Railroad stock, really not something that we typically cover here, but as you can see, the stock really took off here in the last couple of days. We've been basically looking at this stock ever since it broke out here above that 240 level, right? Now it's trading at 277. Our upside target here was 275. So we've effectively already reached our upside target here. Now, Norfolk Southern recently is potentially exploring some merger opportunities here. So that's really kind of what's driven this particular stock higher here. So we'll kind of continue to monitor this. It's pre-market trading at 279. Like I said, our previous target was 275. As a merger target, we could see this trade even higher from where we are right now. So that's really kind of where I'm looking at this particular stock as a potential, as it broke out to above kind of its all-time highs here. Now that it broke out above all-time highs, if it can hold that, that's really where we can see some further upside here in Norfolk Southern, okay? The next one I want to take a look at here is Alphabet. We've been talking about Alphabet here for the last few weeks. And Alphabet also recently making a meaningful breakout here. We took Alphabet basically on the pullback here to this trend line. We thought that pullback was an interesting opportunity to get long that stock, and it's rallied nicely off of that bounce. And recently it broke out above 180, which has been a double top here, broke out, retested it as support, and has now launched itself even higher. You have a 202 gap fill here to the upside. That would be our immediate upside target now that we've reached our initial target of 185. Alphabet trades at 19 times forward earnings, which is quite inexpensive given the fact that they are expected to grow EPS by about 13%, revenue of about 10.5%, but more importantly, net margins are north of 30%. So they generate 30 cents in profits for every $1 they generate in revenue. So far more profitable than most companies in the S&P 500, far more profitable than most even Mag 7 stocks. So for those reasons, Alphabet trading at only 19 times forward earnings is by far the cheapest Mag 7 stock and has a fairly substantial exposure to AI. So if you like AI as a theme, I think Alphabet is probably one of the most reasonable valued stocks to allow you to get exposure to AI out of the Mag 7 stocks. Another one I've been taking a look at here that hasn't performed as well is Target. We basically were looking at Target on the breakout here above this $100 level, right? We basically saw this big decline, and the question was whether or not we were starting to see a bit of a reversal here from this decline. And we got the breakout here above 100. We've come back to retest 100 multiple times, and we're looking for that breakout here to the upside. Our upside target is 130. We haven't quite seen that breakout here. So we'll continue to monitor this. From my perspective, if the stock gets below 100 in the next few days, that would be a reason that the timing on this isn't working out, and I would get out from any long positions here on Target. So I wanted to update you on that. But Target still trades at 14 times forward earnings, which is a heavy discount to the industry. It's expected to grow EPS in line with the industry. The only thing that Target is struggling with is revenue growth. Revenue growth expected is around 1 to 2%, which is below the industry average of around 5%. But Target is, net margins of 4% is higher than 75% of its peers. So it's more profitable than most of its peers. And it pays a 4.25% dividend yield, which is anything in its group, Walmart, Costco, Kroger's, whoever you look at in this particular group, it doesn't hold a candle in terms of its ability to return cash to its shareholders through dividends. So for those reasons, I like Target, but like I said, if it can't hold $100, that invalidates our trade. So even though we still maintain a bullish view here on Target because it's still holding 100, this is on our watch list potentially to cut from our bullish list if it breaks down below 100. So if you have a position here in Target, just be aware of that, okay? The next one I want to take a look at here is Micron. And we've been talking about this stock here for a few weeks now, but I happen to think that the recent pullback here, we started liking Micron here as it broke out here above 90. Broke out above 90, consolidated for a while, and traded all the way up to 130 in a really quick move here. Since then, the stock has pulled back here to call it the 110, 112 level here. And I think this is a great opportunity for anyone who has missed out on any of these moves to potentially look to acquire the stock here at these specific levels. The risk to reward looks far more favorable on these pullbacks here. So Micron at the moment still trades at around 9.5 times forward earnings, which is slightly below the sub-industry median within kind of memory type companies that trade somewhere around 10 to 11 times forward earnings. So it's not a heavy discount, but it's trading at a slight discount to the industry. But if you look at EPS and revenue growth, Micron significantly outpaces its peers. Net margins of 18% also outpaces its peers. So for those reasons, the fact that it trades at a discount is really what I find attractive. And, this is a stock that has been range bound here for, in this particular range for quite some time here, right? So the fact that we've kind of broken out above that range, come back to retest that range, this is really where the risk to reward ratio looks very, very favorable at these specific levels. What do I mean by that? If you take a long position here at these levels, your potential upside versus your potential risk is very favorable, right? Even if the stock trades down to even 110, 107, 108, I would say, maybe the timing on this isn't right. So you're risking in this particular case somewhere between you're risking somewhere between, call it $4 to $6 to the downside versus your upside, is in the $30 plus range in terms of your potential reward. So you're talking about a risk to reward that's incredibly favorable right now, especially if you factor into kind of the valuations that Micron's trading at. So I really like Micron here at these specific levels. And then at the same time, we're looking at some bearish trades here as well. And the first name that we are looking at here is Tesla. Tesla, as you can see, continues to struggle here, right? This is a stock that has continued to struggle. It recently traded up to that trend line. And that's really where, again, the risk reward looks favorable for adding some bearish exposure here. Tesla trades at 175 times forward earnings, which is really hard to wrap your head around in terms of what justifies that kind of valuation. And, investors will tell you because it's a robotics company, that it's a robo-taxi company, it's a battery company, it's a tech company, it's a company of the future. And all of those things, in my opinion, are legitimate reasons for Tesla to trade at a premium valuation. Not to mention, EPS and revenue growth is substantially higher than the industry. Net margins are substantially higher than the industry. There's no question about it that Tesla is industry leading within kind of the car manufacturing space. But we have to be realistic in terms of, a lot of those growth expectations and profit margin, superior profit margins have been eroded substantially here in the last couple of years. The Chinese car manufacturers have eaten away into a lot of Tesla's future potential. We've seen them, have very aggressive price cuts in the last couple of years as a result of competition here. Tesla has missed sales targets multiple quarters in a row. So despite all of these reasons being valid reasons for Tesla to trade at a premium valuation, it really still makes the fact that Tesla trades at 15 times the closest, or the industry's median valuation, just really impossible to justify. You could say, okay, there's all these reasons that are going for Tesla, so it trades, at double the valuation of the industry or triple the valuation of the industry at a stretch. I can sort of get my hands around that. But for something to trade at 15 times the valuation that the median stock trades at is really just hard to wrap your heads around. So, but the thing is that the stock has always traded at a premium valuation, and it's always traded at a very, very, very rich valuation. So that alone is not enough to short the stock. You really have to have a technical reason from a timing perspective to say now is a good time to short the stock. And that's really where I look at this particular trend line here that has been in place here for close to a year now. And this is the third time that we're touching that trend line. And that's why I think the risk reward looks somewhat favorable to take a bearish position, because if Tesla rises to, let's say, 350 over the next few days, then I would say, the trend line has been violated. It's time to get out of your shorts. The risk to the upside is relatively small compared to a downside potential here. We're really looking at maybe the 220 level as our downside target here if we do break down. And even in a very conservative level, you're looking at 280 to the downside. So your risk reward looks very favorable for a downside exposure here right now for Tesla. The next one I want to take a look at here is Walmart. Walmart is sort of a antithesis to the target trade that we just looked at, right? Walmart, as you can see, has been a strong performer here over the last, call it, let me make this a little bit easier to read. Tesla has been a strong performer here in the last couple of years. This was a $50 stock back in 2023, at the end of 2023. That's now a $100 stock. So the stock has doubled here in the last couple of years. Now, here's the thing is that, has profits and revenue doubled in the past couple of years? And the answer is no. Walmart's trading at 36 times forward earnings, which is a valuation that it hasn't traded in since 2000. basically during the dot-com boom. It's not expected to grow particularly fast. EPS growth of 9%, revenue growth of 4%. That's well below the S&P 500 average. Net margins of 2.75% is middle of the road for the industry. Yet it trades at a valuation that's double the industry average, which is around 19 times forward earnings. So that's really where, again, valuation looks stretched here for Walmart. Trends have started to deteriorate a little bit here. It's failed at $100 multiple times here. And we're just looking for a little bit of downside, not a whole lot, because there are, plenty of positives for Walmart in terms of the business. It's a growing business. It's a steady business. So for those reasons, a higher valuation is justified. It's just that 36 times forward earnings, double the industry valuation, is hard to justify when you have Target that's arguably stronger from a fundamental perspective, trading at 14 times forward earnings. And the last one I'll take a look at here is Apple. And I've been pretty vocal here about being bearish on Apple. The outlook of Apple continues to look pretty poor here. And wrong stock, AAPL. As long as the stock kind of stays below, call it this 215 level here. Whoops, let me draw that line a little better. 215 level here. That's really kind of where I maintain a bearish view here on Apple. And, it trades at 27 times forward earnings, which historically made sense when Apple grew at a rate that's faster than the S&P 500. And every single time, every single quarter, they beat earnings. We've seen multiple quarters of earnings sort of disappointments, if you will. Analysts have slashed expectations for Apple pretty heavily in the last couple of years with disappointing iPhone sales, the Vision Pro not taking off the way that kind of they were anticipating. Just a lot of things not particularly going well here for Apple, not to mention their botched rollout of AI, and now they're kind of seeking third-party resources to potentially integrate AI into their tools. They've kind of abandoned their in-house AI team. There's just a lot of chaos internally at the moment that Apple really needs to figure out before it becomes a more attractive investment. I hope they figure it out. I hope they figure it out soon, because I'm an Apple fanboy. I use all their products, but at the moment, I just can't get myself around the valuation of their stock at 27 times forward earnings. It doesn't make a lot of sense for it to trade at those rich valuations. The stock, from a performance perspective, clearly reflects that. As the S&P 500 is making new highs, Apple is continuing to make new lows over, relative lows for the last 6 months or so. So we're just looking for some further potential downside here for Apple at the moment. And sorry, there's one more stock that I want to take a look at here, and that's T-Mobile. T-Mobile to the downside. T-Mobile trades at 22 times forward earnings. And as you can see, the stock also has been into this downtrend here. And the recent rally here actually presents a more favorable risk reward to add some bearish exposure here to T-Mobile. Trading at 21 times forward earnings is double the industry valuation. So yes, T-Mobile grows faster than the industry, and it's slightly more profitable than the industry, but that in itself, unfortunately, in my opinion, is not enough to justify a valuation that's double the industry average. We have seen subscriber growth slow down here for T-Mobile. When subscriber growth slows down, that rich valuation, I think, is harder and harder to justify. And we've seen that here in the stock price over the last, call it 6 months or so, whereas, again, as the S&P 500, as telecommunication stocks make new highs, T-Mobile has kind of continued to make relative lows. And that's showing us that institutional investors are distributing the stock, not accumulating the stock. So I maintain my bearish view here on T-Mobile in this type of market environment. So with that covers what I wanted to share with you here today. Hopefully this gives you a better understanding of how we are viewing this market from a macro perspective. Certainly, things have seemingly turned around a little bit here in the last couple of weeks with regards to the economic data, the sentiment that consumers seem to have for the second half of this year. Hopefully, that can continue. If that does, we will likely see potentially further upside here in equities. But like I said, 1 month is not enough to reverse a trend. We'll kind of monitor those things and keep you updated. And hopefully this gives you a sense for what are some great trade ideas to utilize for the week. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.